as I say, although the League of Nations models were established then, rather few treaties were negotiated. Work was then done first during the war. The League of Nations still continued during the Second World War, but meeting in the Western Hemisphere. So a meeting was organized by, again, Mitchell Carroll in Mexico, which produced a modification of the model treaty. And because it was in Mexico and involved Western Hemisphere countries with a predominance of Latin American countries, the modifications favored capital importing countries. Now, in the meantime then, with the growth of transnational corporations, what you had was a growth of more elaborate systems of tax avoidance. As I say, there weren't many treaties in the 1930s, but there were already some internationally operating companies, and they had to cope with a situation where there often were not treaty networks. The US-UK treaty didn't come along till 1945, and there were many British-based companies investing in the United States and vice versa. So the first modern tax havens, I think, emerged in the 1920s. By the 1930s, they were being more extensively used. And by corporations particularly, because of this issue about the tension between host and home country taxation, a company based with a home, let's say in the UK, would feel that its foreign profits, it was not legitimate for its foreign profits to be taxed in the UK, particularly if they had already been taxed abroad. Now, if they were remitted to the UK, maybe that was acceptable, but companies obviously grow through retained earnings, so companies started to use what are described as tax havens, convenient jurisdictions, to defer taxation on retained earnings. So since the 1980s, we've had a systematization, if you like, of the use of these facilities, both for tax avoidance and tax evasion. So anti-avoidance measures started to develop in those periods. Okay, the other main form of profit shifting was transfer pricing, already identified, as I've already mentioned, back in the 1930s. And again, the US took the lead. Again, not surprisingly, the US was the home of a majority of transnational corporations in that period. These two approaches to the two kinds of profit shifting broadly, but if you think about it, they're just contradictory. On the one hand, CFC rules disregard the separate entity and say in some circumstances the separate entity's profits can be attributable to the home country, to the parent company, whereas the transfer pricing rules say they must be treated as separate entities. Contradictory situation. Now, to look in a little more detail, if you could bear with me, as they say on the telephone answer lines, control foreign corporation rules, how have they panned out? As I say, the consensus formed around at least three broad principles to conform to what are acceptable control foreign corporation rules. First of all, you need a control test. The owners of the foreign corporation need to be resident in a home country, and there needs to be some threshold of ownership. It's become increasingly difficult as transnational corporations have perhaps shifted to be more multinational now. With regionalisation, it's hard. CFC rules basically are trying to reattribute profit to the ultimate parent. But when you have multinationalisation, that becomes hard to define. Secondly, the idea is that the CFC is a paper entity. It's not really doing anything, so you need to have a passive activity or passive income test. And thirdly, you have the low tax country test. You have to identify what is a low tax country. This is often done by having lists, either lists of countries that are considered to have comparable taxes to your own, or those who have low taxes, one or the other. But that's become harder to apply as you have a proliferation of preferential tax regimes and medium-low tax, if you like. And they're not all Cayman Islands, but you've got Ireland and other jurisdictions that are hard to categorise as low tax jurisdictions. So all those three areas have become increasingly hard to apply. So the result really has been that CFC legislation has got increasingly complicated. And secondly, really a retreat, a shift back to what is called territoriality. But I think that rests on fundamental flaws, which I've already kind of hinted at or mentioned. That basically CFC rules are an attempt to kind of reassert that it's the home country, the country of residence, the ultimate parent or whatever, that has the right or claim to tax foreign profits. But that doesn't deal at all with avoidance at the host country end, which is just as major. But just to illustrate that, only today, when I open my tablet, there's a report from Bloomberg, which apparently gives some data on Google. Google has become an increasing concern of many countries around the world as to how it manages to reduce its taxable income. And according to this Bloomberg report, Google has channeled up to 80% of its profits in 2011 through the Netherlands to Bermuda, resulting in about in a tax saving on its global profits of $2 billion. So this is not insignificant. And in the UK in the last few weeks we've had intensive public debate sparked from a parliamentary inquiry that had the chief executive officers of Amazon, Starbucks and Google being quizzed by parliamentarians who said, you must be joking, you cannot be serious. How can Starbucks not have made any profit in the UK for 12 years? Well, okay, well, I'll get back to that. So this is now, I think, a very serious question. Now, the transfer pricing, transfer pricing rules, probably more of you in this room will be aware of, and probably aware of some of the problems of transfer pricing rules. The OECD says there is a consensus, and in some senses, yes, they've managed to maintain a rather tenuous consensus. But if you look closely, the OECD's current or revised transfer pricing methodologies allow 5 methods for dealing with scrutiny of transfer pricing. 3 of them are described as transactional pricing methods. There's been a retreat from the notion of having a hierarchy, but the emphasis is still on comparables. The language doesn't say that you must find a comparable if possible, but there is a preference for comparables if you can find them, and only then cost plus or retail minus. But then as a result of this conflict with the modification of the American approach from 1988 to 92, the OECD accepted what the Americans call comparable profit and what in OECD parlance is called the transactional net margin method. Now, difficulties with that. Firstly, all tax authorities, and as I said, from the early days of the American method, have found that comparables are hard to find. The issue then becomes, well, how strict are you in defining what is a comparable? When the Americans shifted in 1988, the idea was that they would only accept true comparables and they would use profit split in other circumstances. Initially, you have the administrative problem of actually having the expertise to be able to scrutinize, to even know what a comparable transaction might be. You need to know the industry concern. So to have the expertise is difficult enough. But the experts also find it hard to establish what is comparable and what is not a comparable. And developing countries on top of that have a particular problem, or what might be comparable in developed country relationships is not always comparable. So I think the South African report to the United Nations Transfer Pricing Manual mentions this in particular, that to find comparables appropriate to an African context is very difficult. The other issue then is that transfer price adjustments have knock-on effects. If you have a transfer price adjustment by one tax authority, it might be possible for the company simply to adjust the prices if they haven't already submitted their accounts to the related authority. But if they've already submitted, then they have to consider if they can bear the... But that procedure has, I think, disadvantages. It's a case by case, and it's secretive. But now, From a developing country point of view, until recently, I think most developing countries really neither had the capacity nor, for one reason or another, concerned. But now, increasingly, developing countries are adopting transfer pricing regulations, and there's a capacity building effort from the OECD to build up. And then if you look at, and I've again read in the UN manual, there's a very helpful chapter which has reports from the major countries, Brazil, India, China, and South Africa. And I think they're very instructive because looking at those reports, the developing countries, they're obviously the emerging developing countries with more resources to put at the problem. They have, they say that they're operating within the OECD consensus. But as I already said, the OECD consensus is quite broad. And they're also obviously putting in their own perspective. And they're all adopting, I think, significant variations on the OECD approach, but each of them are also rather different. Brazil has adopted a fixed margin approach, and this seems to be because Brazil, obviously quite a large country with quite a centralized but also decentralized tax administration, and they want to allow least discretion. They want an administratable system which doesn't give a lot of discretion. They don't want to give individual tax inspectors power to bargain about millions of dollars here and there. So they have a legislated fixed margin system, which is administrable and which they defend strongly, but which has run into criticism from the OECD perspective. China, interestingly, makes no bones about the fact that the comparables and even cost plus and retail minus doesn't work, and they emphasize profit split, but they've amended the profit split to take account particularly what they call locational factors. Locational factors are kind of recognized in the OECD guidelines, but only in limited circumstances. The Chinese seem to be making much more use of them. For example, in relation to payments for intangibles, they argue that you need to bear in mind that even if the intangibles are developed by the foreign parent, they will necessarily be adapted to the local circumstances, and the local workforce will adapt foreign imported technology, so they'll use that to adjust the pricing. India, again, a massive civil service, significant resources to throw at the problem, says that they use a holistic method, they use everything, every possible OECD approach. But the result seems to have been really a growth of issues. The Indians now apparently have 3,000 outstanding cases before the tax courts. This is aside from the ones being negotiated, the ones that have been taken to the tax courts. There are now 3,000 cases. And certainly a number of Indian experts have said that a fresh look needs to be taken at it. And for other developing countries, you tell me, but it seems to me that despite all the capacity building, there are going to be serious problems from the point of view of the tax authorities operationalising this system, but also from the point of view of companies. If developing countries now, in addition to OECD countries, are starting to audit in every direction with diverse methods, this is going to, from my point of view, create increasing problems for companies themselves. If the companies don't start objecting vociferously, it can only be because there's enough leeway in the system for them to transfer profits out to be gaining from the system despite all the costs that it leads them to. The costs of administering the system are enormous. In many cases, far more is spent on getting advice on transfer pricing, on paying the big four accounting firms than is paid in taxes. I haven't time, I think, to look at the Dominican Republic example. That's a slightly more heartening example, which I heard presented in a conference recently, where, because of the importance of hotel and tourism there, they did put resources in, and they seem to have had some significant success. So it is possible for developing countries, I think, to manage those rules, but I'd like to hear more about your experiences.